I am so excited for this next talk. It's going to be a fireside with Stuti Pandey. She is a partner over at Kraken Ventures, also a early investor in Athena, a runaway hit this year. And we also have the illustrious Nick Carter. I hope your back is feeling a little bit better. He made it all the way to Singapore, despite the fact that during his training for Crypto Fight Night, I think he slipped to L4 or L5 or something like that. That sucks. Sorry, buddy. He also published recently a report called The Emerging Markets Story by Castle Island Ventures. If you hadn't had a chance to read that report, you totally should. Required reading. And I suspect that during this talk, we'll actually get a lot of insights. I myself am actually participating in a boxing match tomorrow, so hopefully you can give me a couple of tips. So without further ado, let's give a big round of applause to Stuti and Nick.
Am I sitting here? Okay, sorry.
Hi. Okay, so stablecoins have become one of the biggest and important stories in financial innovation for this past decade. You know, they've evolved from a trading instrument for crypto traders to a lifeline for many in emerging markets that are using them for access to stable financial systems. So today we're going to unpack a report and some of the trends around what is happening in emerging markets around stablecoins with Nick. Nick, can you introduce yourself?
Hi, I'm Nick Carter. I'm a general partner at Castle Island Ventures. And we invest in stablecoins at every area of the stack, from issuers to B2B, consumer, fintechs, remitters, you name it. On and off ramps, we love stablecoins. I think it's the biggest thing happening in crypto right now, and really excited to be here and talk about my research.
Awesome. And I'm Stuti. I'm a partner at Kraken Ventures. We're linked to the exchange, and payments and stablecoins are one of our most important topics. Our thesis is that blockchain is better technology infrastructure for financial services. So with this, as a researcher and investor in the space, it's actually quite hard to find data and insight on the human side of how crypto payments are being facilitated and used. And that's why I was very excited when a week ago this report was released. And Nick, could you give more insight on what is the theme of this report and how it came together?
Sure, yeah. So in crypto, it's interesting. We're kind of awash in data. We have plenty of on-chain data, but that's very high-level data. That's the truth of it. On-chain data, I started a data company, Coinmetrics, but that doesn't tell us that much about what's actually going on. It doesn't tell us about the individuals that are using stablecoins. And so we have some, general feelings that stablecoin adoption is growing. Chainalysis puts out a good geography of crypto report. They just put out their fifth one just last week as well, which is interesting, but that's country level data. It's very aggregate. And then we have on-chain data that shows us there's X many active addresses, around 25 million a month on all blockchains using stablecoins. There's 120 million addresses on-chain that hold a non-zero balance of a stablecoin, and according to my estimates, stablecoins settle around $5 trillion a year. But we don't know what people are doing with stablecoins. It doesn't tell us that much. We talk to report codes, and they'll tell us, people are using stablecoins in Argentina and Nigeria, et cetera. But we don't really know what's going on. And I had this hunch that stablecoins have achieved traction outside of just crypto, right? They started as a tool for traders to settle up with exchanges and to hold dollars without having, to go back through the bank system when they wanted to onboard collateral to those exchanges. But I felt that stablecoins had decoupled, and the main thing that showed that to me was when we had the significant bear market of 22-23, stablecoin adoption by any metric kept growing throughout that period. And so to me, that demonstrated that stablecoins had crossed the chasm and become a real consumer use case independent of the crypto market cycle, right? So that was a little data point. And the problem was we didn't have any good data, especially in emerging markets where we know stablecoin adoption is paramount. We didn't have any good data on who is using these things, what are they using for, et cetera. And I set out to solve the problem myself, frankly. And so I commissioned a study. We hired YouGov. They're a pollster. They do political polling. Visa very kindly helped us do it, and Brevin Howard Digital as well. And we went to 5 countries: Brazil, India, Indonesia, Turkey, and Nigeria. That's 5. And we asked 2,500 individuals everything about stablecoins, how they, and specifically stablecoins, because people have done these surveys, but for crypto in general, I care about stablecoins, right? And we ask them what blockchains they use, what wallets they use, what do they do with stablecoins, what non-crypto things do they do with the stablecoins? Are they using it for payment, for remittance, for cross-border, for payroll? Are they just using it as a digital dollar instrument? What stablecoins do they like? How often do they use stablecoins? So we created an abundance of data. The one caveat I will mention, so we published a study, you can find it on castleisland.vc on our website. The one caveat is we did not do a general population survey. So I could not tell you, based on this data, that X% of Nigerians are using stablecoins for Y, because we had to specifically narrow it down to existing crypto users. So this was not a statistically significant general population survey because the penetration for stablecoins is pretty low. It's 10% in these countries, give or take. So I would have had to poll 10 times as many people to get that data, and that's enormously expensive. So this is a first draft. Hopefully we can build on that and do bigger studies in the future. So that was the premise.
And how would you say that this adds to the body of knowledge on crypto adoption, payment adoption, et cetera, in the space?
I mean, it's brand new data. This just didn't exist before. It doesn't tell us everything. We only did 5 countries, and it was a relatively small sample of those countries. But now I can tell you what these crypto users are doing with stablecoins, whether they're using it for trading or something else. And so this is net new data. I think it'll be very accretive to the policy conversation. And as we interface with TradFi people that don't believe that there's real adoption of stablecoins.
And what kind of assets and networks did you take a look at in the study?
All of them. So actually the number one network was Ethereum, believe it or not. I thought it would be Tron. It was Ethereum that people use to transact stablecoins, followed by BSC, Tron, and Solana in that order. And then we asked them what wallets they used. The number one wallet was the Binance exchange. It's not even a wallet, but people use it as a de facto bank, effectively like a non-custodial wallet, which is funny. And then it's the other ones you would expect: Trust Wallet, Crypto.com, Coinbase Wallet, things like that.
And just to have a little throwback, like the payments narrative at one point in crypto was dominated by Ripple and XRP and Bitcoin Lightning. What happened to those? I also noticed those weren't in the report.
Yeah, I mean, XRP is a great case study in why stablecoins are great and why native crypto assets are not so great, right? They, for the longest time, tried to push XRP as the bridge currency. And no disrespect to any Ripple folks in the audience, but that did not come true, right? People don't want to use a bridge asset, something that's volatile, that doesn't necessarily have the best liquidity. They want to use a stable asset for their bridge transactions if they're doing a end-to-end cross-border payment or remittance. And now Ripple capitulated and they said, okay, we're going to issue a stable coin. So they get it now. It took them a really long time. So, and the Bitcoiners would say the same thing. They said Bitcoin's going to be the bridge asset between FX. It wasn't Bitcoin. It's stablecoins. Stablecoins do more on-chain volume than Bitcoin or any other crypto asset for that matter. And this is one of the reasons I published the report. We shared this data. It's very clear. Blockchains are about moving dollars. They're not about moving anything else. The dollars penetration on blockchains was 0 in 2018. It's about 50% today. It hit 70% in 22. And it's just only going to continue to increase. So I think the success of stablecoins really undermines a lot of those narratives that we've had in the past about native crypto assets being the bridge currency.
And the report highlights the diversification of how stablecoins are being used. Could you elaborate on what some of those interesting and dominant emerging use cases are outside of crypto trading?
Yeah, so the main question we ask these people is, what's your primary goal when using stablecoins? So across the entire sample, the primary goal was trading crypto. That's fine, I get it. We're polling crypto users. The second thing was holding dollars. And so it wasn't actually cross-border payments, it wasn't remittances, it wasn't payroll, it was just holding dollars. But then if you dig in at the country level, it depends. So in Turkey, the number one goal was yield provision. And so I'm actually very curious for why that's the case, I don't know. But that was the primary goal of the users we polled above using crypto, is they wanted stablecoins to earn a yield. In Nigeria, which by the way, of the 5 countries in our sample, Nigeria was top in every category. So I gave a talk yesterday at Token about crypto dollarization. My view is it's happening in Nigeria based on this data that I found. The Nigerian government's panicking about crypto and stablecoins. They're putting Binance executives in jail. Honestly, I get it. It seems to be happening. There seems to be a crypto dollarization event there. So in Nigeria, the number one goal was not trading crypto. It was getting access to dollars as a savings device. And what's interesting about this is in both Turkey and Nigeria, you can get a dollar-based bank account. Maybe not everyone can. Maybe it's only the middle or upper classes, right, the more affluent types. But you can get a dollar-based bank account. So why would they want to use a stablecoin if you can get a dollar liability from a bank? Well, it's because a stablecoin is a more credible liability. You are facing off against, Tether or Circle or Paxos. You're facing off against an entity that's fully reserved. If you are an emerging market user in some of these countries, you have had experiences where you've had dollar liabilities in banks, but the banks are Ponzi-like systems that the central bank is plundering. Argentina is a great example, right? You had a dollar claim in that bank in 2000, 2001. Overnight it vanished and it was devalued because the banks didn't have the reserves. The other thing about banks in these places is there's capital controls. In all those 5 countries we did the survey in, there's capital controls in all of them. So you don't actually have the freedom to use those assets the way you'd want to. Stablecoins give you that transactional ability currently. Maybe that'll change. And the quality of the reserves underscoring the stablecoin is much, much better. And of course, it depends on the issuer. But if it's PYUSD, for instance, issued in New York, NYDFS, you're facing off against a credible US firm. They have full reserves. That's bankruptcy remote, and it's regulated by a strong regulator. That's much stronger claim than a local dollar liability of a bank. So that's one thing I wanted to impress upon people is stablecoins are actually better than dollar banking in a lot of these countries. That's why we see people prefer them.
And so these different countries seem to have different dominant use cases for why they use them other than crypto trading. Like, what do you think are the reasons for why they value different features?
Yeah, I mean, the world's a big place, and we picked these 5 countries because they're each in different regions, right? And there are some commonalities. So in my talk yesterday at Token, I'll publish the slides, I developed this model for propensity to adopt stablecoins. And the things that all these countries had in common is weak property rights, typically a history of high inflation, a banking sector that's non-functional, costly remittances, so they're not fully integrated into the financial system. And so those are the things that are generally in common, and the existence of capital controls. But yeah, you're right. Some of these countries we covered have high inflation, others don't. Some have very functional banking systems, like Brazil, very functional banking system. But there may be capital controls. It may not be as integrated into global finance as other places. Turkey has I would argue, pretty functional payment system, but a very high inflationary episode. So one thing I'd like to do, and to expand on these results, is to understand the typology of the countries that are adopting stablecoins, understand whether this is a macro reason, whether this is people are adopting stablecoins because the dollar has a higher real rate and they can earn interest on holding a stablecoin natively, or they're adopting it because there's just a huge episode of inflation, or they're adopting it because remittances otherwise are very expensive. So I think there's a lot of reasons why you'd adopt stablecoins. And it basically boils down to they flatten the topology of global finance. So going from one currency to the next is cheaper. And of course, the dollar is generally less inflationary than a lot of these currencies. So there's kind of 2 broad reasons, I would say.
And to circle back to something you said earlier, like with Turkey and seeking yield. So I find that in crypto, yield is often conflated with being degen, whereas in traditional finance, yielding instruments are usually reliable and lower on the risk curve. So first of all, what do you think has happened there? And second, where do yielding stablecoins fit into this market map, since they are not really in the top players?
Well, the fact that yield is a bad word in crypto, you can probably blame Do Kwon for that. But we forgive and we forget here. So today, it's the case that there are plenty of natively yield-bearing stablecoins that just pass along the T-bill rate, or if you want to go higher on the risk curve, you can still use something like Athena, which is very different. So that is not the risk-free rate. You have to understand the risks there. But this is an interesting transition that's going to happen in stables. If you're holding Tether or USDC, you're just financing, you're swallowing a 5% carrying cost that the issuer is internalizing that you're not receiving. I actually thought this transition would happen faster. I thought yield-bearing stablecoins would be 30% of the market by now. I think they're, what, 2-3% of the market? It's actually kind of shocking. But if you compare a yield-bearing stablecoin or just any stablecoin up against a latent inflation rate in your home country that's 30%, maybe you don't care about the 5% extra juice. You know, maybe you're just happy with the dollar. As things stabilize, though, and yield-bearing stables become more popular and more widely understood, I do think we will have this transition away from the stablecoins that internalize the yield to externalizing, and you have a race to the bottom.
And what do you think is the role of DeFi-issued stablecoins, such as DAI, now USDS, now as well as in the future?
Well, I mean, with all respect to Rune, we asked the users what stablecoins they like, and they just like Tether, So I don't think they are that concerned with the intricacy and the decentralization and how cool the mechanic is that causes a stablecoin to exist. They care about reliability, ubiquity, liquidity, and network effects. They don't care also about what the Wall Street Journal has to say about Tether. They couldn't care less, frankly. So based on my survey, I'm just seeing that they like the most efficient instruments that have the narrowest spreads against FX and are the most ubiquitous and the easiest to use. We didn't see a lot of folks saying, oh, we like DAI or Liquidity or you name it, your DeFi stablecoin. We haven't seen that.
And the report indicates Tether's continued dominance despite increased competitions. Like, I think I've seen 200 stablecoin pitches in the last 2 years. Why do you think Tether has been able to remain so resilient, especially in these markets?
Yeah, it's a good question. I mean, as I said, I don't think ordinary Nigerians and Brazilians and Turks care at all what the Western press has to say about Tether and how bad it is and how these are nasty people and they committed accounting fraud or whatever. They don't care. They just want to make their lives better. They want to be integrated into global finance. They want to run their businesses. They want to denominate their savings or their corporate balance sheet in something that is stable. And Tether has by far the most liquidity. It has the narrowest spreads. And we're dealing with the flattening of global finance. And so I think you are seeing this Pareto principle at play. Tether's at 70% right now. I don't actually see that changing unless something very drastic happens. So this is a real expression of kind of like stated versus revealed preferences. While the narratives around Tether may be sour, at the end of the day, people just care what is the most liquid and widely supported stablecoin, what is used by their infrastructure, whether they're using it through a third-party wallet or something like that. So yeah, that was kind of an eye-opening thing to me. Is just people just don't care about the narratives.
And what do you think are the catalysts necessary for further stablecoin growth in emerging markets? It feels that the benefits are so obvious, but actually total penetration is quite low.
Yeah, I mean, I think moving away from the sort of like write down 12 words on your smartphone and put it on a piece of paper and store it in the closet or something. We have to move away from that. I was very impressed by the demo I saw by the Opera team, actually, MiniPay. That's getting traction in emerging markets. That's using cell phone numbers as opposed to addresses. So UX improvements like that are huge. We see that happening in real time. And then more banks getting into the game. It's not going to happen in the US, but offshore banks intermediating stablecoin of fiat transfers. That's the most costly thing.
And how much of that is in our control? Because I also think that's kind of the toughest part of the value chain for crypto payments.
It is. The last mile is. That's where the most, if there's 300 bips of cost, that's 250 bips. So that is by far the most important thing. I'm seeing great traction. Global banks get into it. That excites me. And eventually we're going to dramatically be the lowest cost provider when compared with traditional remitters.
And as you were doing this report or even following up on the analysis, like what were some other metrics or emerging trends that you saw that might give us an indication of what future of stablecoin growth and the kind of segments it's going to be penetrating in the future? What is it going to look like?
Yeah, I think the archetype for the kind of country that's going to experience crypto dollarization, Nigeria is a perfect example. Weak property rights, low trust in local institutions, high inflation, but an entrepreneurial and active and young population that wants to be integrated into global finance. These are regular folks that are earning their salary from a foreign startup and they're receiving it in dollars. They want to, do cross-border payments. So if you're looking for the next country where that's going to happen, I would look at something similar. A currency that doesn't really work, and a payment system that's poorly integrated, expensive remittances, and a population that wants to earn a livelihood and be entrepreneurial. That's what I'd look for.
Cool. All right, thank you.
Thanks, Stuti.
What a phenomenal fireside chat. Let's give him one more round of applause, everybody.